watching the markets and the geopolitical things and all the stuff going on. We're going to, of course, have to talk about the war in Iran and how that's affecting the markets. And I think one of the biggest plays in the market right now is when oil is at above $100 a barrel. I do believe that investments are going to end the year well unless something unpredictable or catastrophic, especially on the geopolitical stage. It'll be on the geopolitical world stage that somehow, things escalate further in the Middle East. And welcome to the Wise Money Guys radio show. I'm your co-host, John Schambra, and I'm actually sitting here with my daughter, Madison Schambra, for her first ever Wise Money Guys show. I think we may have to call it the Wise Money People show, right?
Or Guys and Gals.
The Wise Money Guys and Gals show. I kind of like it. Actually, I do. I kind of like it. So I might as well start off with an announcement. So you're listening to the Wise Money Guys show, as I said, and new to our firm as of, the 1st. Yeah, as of the 1st on April Fool's Day, coincidentally, Madison Schambra has joined the firm as one of our newest team members and successor. So that'll give us even more longevity because I, being the senior statesman that I am, recently partnered up with Giuseppe Viscani, who, by the way, is on vacation this week, traveling with his family and probably having a lot more fun than watching the markets and the geopolitical things and all the stuff going on. But we'll talk more about that later in the show. But first, this show is brought to you by One Source Wealth Management, which is a registered investment advisory firm, license number 319078. For more information, you can visit our website, which you can find by going to wisemoneyguys.com. Scroll down to the end of the page for disclosures, and there is definitely lots of great information throughout the website. So feel free to explore our website, look at the articles, the videos. There's a chat function. You can always sign up there for a no obligation consultation. And of course, if you have any comments or questions or want to schedule a meeting by calling us over the phone, you can do that by calling 916-967-3500. Before I stop talking about our company and the announcements, I do have another announcement that Madison and the whole team will be joining us and there for answering questions at our April seminar, which this one, we just did one in the beginning of March. That was in Roseville. This one's going to be in Walnut Creek at Diablo Hills Golf Course. It's on April 29th from 6 to 7:30 p.m. Again, at Diablo Hills in Walnut Creek. That is a Wednesday. So if you are retired or about to retire, you don't have a financial plan in place, you haven't updated your financial plan in a while, you're concerned about the markets, you want to see if there's ways to increase your income or get better results, or put that plan in place, as I said, or just get a second set of eyes, eventually looking at what you're doing and seeing if you could do better, you'll want to attend our seminar again on April 29th from 6 to 7:30 p.m., which is a Wednesday at Diablo Hills Golf Club in Walnut Creek. So this show, we're going to be talking about the economy. We're going to, of course, have to talk about, the war in Iran and how that's affecting the markets and where we're at. And I've got a bunch of I told you so's in there to mention. We'll naturally break down what's been happening recently with the volatility in investments and interest rates and especially oil, as well as we will definitely talk about, strategy, just a high level of what to be doing right now or what to consider right now. And then on top of that, Madison, it's tax time. April 15th is the deadline. We are not tax preparers or tax advisors, although we are armed and dangerous on tax consequences from investments and how to employ different tax mitigation strategies. And then we also work with your tax advisors and attorneys to make sure that you have a comprehensive, financial approach to taxes, your estate, your financial plan, your investments, so on and so forth. So first, let's talk a little bit about the economy. So I don't know if you saw, Madison, maybe you're now becoming a student of the investment news, but did you see that? And you can just, laugh and say no if that's, and then maybe we'll touch upon your background a little bit, but jobless claims went down. So, despite the noise in the news, the very left-leaning news that, oh gosh, the tariffs are going to be inflationary, the tariffs are going to destroy the economy, oil is going to destroy the economy if it goes above $100 a barrel. And here we are. Tariffs did not destroy the economy because they did not make inflation go out of control again, like it was during the Biden administration when we had inflation increases to the likes that we haven't seen since the 70s. In fact, inflation is still running very low, not as low as a record low, but still running in the mid twos, maybe even low twos, depending on how, the government and the Bureau of Labor Statistics and the Fed manipulates the data, either adding in energy and food to make the inflation number higher, or backing out energy and food to make the inflation level less. So whatever the case may be, inflation overall inflation is very controlled right now, despite oil going through the roof. In fact, just jumping ahead a little bit to oil, I don't know if everybody saw Trump's speech, just updating us about what's going on in Iran, but basically it was, hey, during the speech, we were 32 days in. He was talking about that Iran has asked for a ceasefire. Also called out our European partners, supposedly our allies, that heck, they were going to have to do a heck of a lot more to open the Strait of Hormuz, because as the president said, and the data shows, we don't need oil out of the Strait of Hormuz. In fact, I heard and read on the news that our barrel reserve level has gone to the highest since June 2024, and so it just kind of makes you realize that what the news reports and the sensationalism and the fear mongering and the scare tactics is very one-sided. They don't report anything on the side of that, heck, this is good for us overall because this will make us more reliant on our own oil. This is what President Trump ran on, Madison. In fact, the drill baby drill is fortunately happening and coming to fruition because, again, our oil reserves are increasing. So we are outpacing demand with supply right here in the United States. So, and I love a statement he said during the week, during this speech, was that, hey, we don't need any oil from the Strait. And, if you're going to want to, get your oil free flowing again that you get out of the Strait of Hormuz, you're going to have to do it yourself. What do you think about that? No opinion. Okay, no opinion. But nevertheless, the economy is pretty resilient, is very resilient in the U.S. It's expected that there was more job hiring coming, and that the new jobs numbers are going to be revised up. So that's another good economic indicator. And again, this temporary volatility that we're seeing is what I said it would be last week, the week before that first and foremost, do not panic. This, in my opinion, is going to be a very temporary setback. And in fact, I think one of the biggest plays in the market right now is when oil, is at above $100 a barrel. And I think West Texas crude hit $110 a barrel, to actually look at different ways that you could short oil, whether it's buying puts on USO or literally, buying puts on some of the oil companies, or shorting their stocks. There's many ways to play the extreme new highs in the price of oil, in the price of gas and oil companies, so on and so forth. Now, if you're managing your own money, or you're working with a firm that does not have the experience, the understanding. In fact, typically, even if you're working with an advisor, a financial advisor, and I put that in quotes, and the reason why I do that is because most financial advisors, do not have the experience or capability to do, strategies such as hedging, or shorting, or using options. Now, the reason why they don't is because their firms typically don't allow them to do that as a financial advisor. They leave that to the portfolio managers, which is what Giuseppe and I are. We are portfolio managers first, fiduciary portfolio managers as your advisory firm, and then we're financial advisors, second. And the reason why I say that is because we're not incentivized to sell you other people's stuff. As a fiduciary, we get paid fees on your account, and those fees go up when your account value goes up. Those fees go down when your account value goes down. So we are operating in your best interest, not our own. You can't say that you're operating in your client's best interest if you're charging commissions or selling a product or service that has commission built in. That is not a fiduciary. So being a portfolio manager, a discretionary portfolio manager, is something that takes a lot of experience and time to have the level of understanding and capabilities that only being battle tested could give you. And that's what I really like to point out, that when you work with Giuseppe and I, we are battle tested, which simply means that we've been doing this a combined very, very long time through good markets, bad markets, high interest rates, low interest rates, good economies, bad economies, high inflation, low inflation. And we've been relied upon by our clients through all of those various times. And I believe, if you're going things alone, especially if you're retired, you should not. And I'm going to tell you why when we come back. You're listening to the Wise Money Guys and Gal. Stay tuned. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your host, John Schambra, and I'm here with my co-host, Madison Schambra. Again, that makes us the Wise Money Guys and Gals. And so we were talking about the economy a little bit. I was also starting to go on a soapbox about Giuseppe and our experience, over a combined, is it more than 50 years now? Yes. So I'm since 1992 and he's since 2008. So that's what, 34 years for me and basically 16 years for him. No, 18 years for him. So yes, we are well over 50 years in combined experience, but nevertheless, what's important about that is that we've been helping clients with their financial decisions, especially ones that affect their retirement or their estate or their legacy or their taxes or their financial plan or their insurance for a very, very long time. And so I'm just curious from your perspective. First, let me give you a little bit of Madison's background. So Madison, first of all, is highly educated after graduating, cum laude from U of A.
Yeah.
And then also then going on to get her master's degree from USC. She was an executive administrator to the president of a famous baseball team, as well as an HR director for another team.
The San Jose Earthquakes,
Yep.
MLS, Major League Soccer.
So operations, administration, that is what we hired her to handle for us. She is our new operations director. And so we're thrilled to have her because, quite frankly, we needed more support folks. We also have Kathy, our admin manager, and with both of their help and experience, that will free up Giuseppe and I to, focus on your investments and your planning and focus on meeting with our clients, which we still primarily like to do face to face. But if you're not in the area, and we can't arrange an office because we do have other offices at our disposal, albeit we're based in Granite Bay, California. We do have an office in Walnut Creek that we utilize for our Bay Area clients. And then we also have an office that we utilize in the Reno, Nevada area that we use for our Tahoe and Reno clients. But nevertheless, Madison and Kathy are just crucial to supporting us so that we can focus on you, our clients. But I'm just curious about how you're a millennial, technically, right?
It depends on who you ask. Some people, so I'm 95. Some people say,
born you're 95.
Yeah.
You mean born in 1995?
Yes.
Okay.
1995.
Yes.
That's better.
Yeah.
Some people say I'm a millennial. Some say I'm Gen Z. And I've even been reading lately, they're combining the two into Zillennial.
Doesn't that figure? Zillennial. I kind of like the name though.
But the mid 90s babies, we can relate to social norms in the later part of the millennial generation, as well as the Gen Z generation. Plus we're old enough to remember 9/11 and some pre 9/11. So depending on who you ask.
So your dad's pretty conservative. What do you think Zillennials are? What do you consider yourself conservative politically, or you're definitely not liberal?
Oh, absolutely not. Definitely more on the conservative side. Mm-hmm. The purely Gen Z, not the Zillennials like me, I would say are more liberal leaning, especially the ones that are in college. Let
me tell you how that relates to investing and financial planning. Some of these companies, the BlackRocks of the world, big fund company like BlackRock, they went down that path of ESG investments, which was just ridiculous because ESG investments focused on ESG and then DEI versus focusing on getting you the best return possible for your risk tolerance, for your goals, and that's what it's important about investing and being a fiduciary, not, whether or not, the fund is green or whatnot. Nobody cares about that, especially if that particular investment, because it's ESG or DEI, is losing money. I mean, the reality is that we're here to help you meet your financial goals, not here to, move. And even though we mentioned politics as we just were, it's not a political show. Our goal is, how do geopolitics especially affect your investments? And I like to say infect, because it is an infection. What's going on in the world, like I said earlier, the first part of the show was that the sensationalism of what's going on in the Middle East, which basically should have no effect on our gas prices, but is having effect, is widely because of the sensationalism of the story, the fear mongering, not the actual effect of supply and demand on our oil and gas. Because quite frankly, as I said, supply is outpacing demand, and therefore the prices of gas should not be going up, but they are, which is why I believe that this and any dips, which have proven to be a good strategy. First, not panic. Second, buy on dips, because I do believe that this will be a short conflict. And immediately when the conflict is resolved, and whatever that means, oil prices are going to drop like a rock, not like a feather. They're going to drop like a rock, in my opinion. And when that happens, the market, because of how well our economy is doing, unemployment is low, companies are hiring and expanding, GDP is still positive, interest rates are relatively low. Those are all indicators of a booming economy, which then yields potentially a booming stock market. I do believe that investments are going to end the year well, unless, and I do have to say, unless something, unpredictable or catastrophic, especially on the geopolitical stage. It won't be on the U.S. economic stage. It'll be on the geopolitical world stage that somehow, things escalate further in the Middle East. Does China now do something? Because really, China and Russia get so much, and India gets so much of their oil from the Strait of Hormuz. In fact, I believe the number, and don't quote me on this, but I believe the number is somewhere in the neighborhood of 20% of China's oil comes through the Strait of Hormuz. So even though there's been articles and information out there that's saying, a lot of China's and Russia's oil is still flowing freely, it's not flowing as freely as what it was prior to us addressing, Iran and its reign of terror over the last 47 years and its path to nuclear weapons. So why do we care about that? Again, just to recap, is because how it infects your investments. And right now, strategically, couple of things. A, don't panic. And B, look to great value companies on dips. That's what we are doing. And C, always have a good portion in cash or cash equivalents, like a money market fund, to cover your reserve needs. Don't look to sell your investments when it's bad timing. And if you're 100% invested, maybe on the spikes up, what we like to call dead cat bounces, sell a little bit to raise cash if you don't have at least, 3-6 months cash equivalent of whatever your, spending needs are over that time frame. And also keep listening to the Wise Money Guys and Gals. I'm John Schambra, here with my daughter, Madison Schambra. If you'd like to give us a call or set up that no obligation consultation or come to our April 29th seminar, call 916-967-3500. Stay tuned. We'll be right back. Welcome back to the Wise Money Guys and Gals radio show. I'm your co-host, John Schambra, and I'm here with my daughter, Madison Schambra, our newest team member and director of operations. And I'm just curious what you think about the economy? I mean, maybe housing or groceries or rent, or, what do you feel as a 30 something year old?
Definitely feel behind the curve. Like when I look back at what you and mom did around my age, you already had a home.
Yeah.
You were able to afford. Were both of my sisters born?
Well, when we bought our first house, was in 95, and no, you let's see, you were 95, and then help me on your sisters. They were 98 and 99. But yeah, we had already owned a home, which albeit was a very small home, and it was $149,000 in 1995 in the Central Valley. But yeah, so we were able, and let's see, how old was I in 95? So I was
27.
I was 27 in 95. So yeah, we were able to buy our house in our 20s.
And I'm 30, and I cannot imagine being able to afford a home and have 3 babies.
Well, there was funny. There was, some noise around, and I heard this on the Sean Hannity show and some of the other shows on Fox that, on The View, they had mentioned that, and it was one of the ladies or guest ladies on The View was saying it's basically irresponsible for women to have babies right now. Irresponsible. I don't even, and don't quote me on that being the exact words, but yeah, that just seems ridiculous. We if you plan to afford having, children, you'll never have children.
Well, I do remember you telling me you never felt like you made a reasonable income until you had children because you had no choice.
Yeah, well, I don't think men, again, this might be referring to me personally, but I don't think men get a brain until they're at least 30. And then
that's probably true.
So at 27, I don't know how mentally, ready anybody is, especially men, to raise a family and have babies. But when we did, all I knew is that it was go time. It was responsibility time. I was going to do whatever it took to be able to provide for your mom and you and your sisters. And I think often that's part of the problem with, what's happened over the last, 30 years since I was 27 and since you were born, is that now, this generation, the Zillennials, and what's younger than Zillennials? Gen Z, and then I guess new kids are iGen.
I think they're iGen.
Yeah. So now it's like, okay, look to the government, look to a handout, look to blame somebody else, look to not take financial responsibility for anything. And again, I don't know if that's, one side of the aisle or the other, propagating that, but you can make it in any time frame. Yes, there's things going on, but that's not different than any time, in our history. There's always, periods of, like I said earlier, and part of being battle tested, there's always periods of, high unemployment, low unemployment, jobs are plentiful or not plentiful. Interest rates are high. In fact, when we bought our house, our mortgage was 7.75%. And yet, now at around high 5s, low 6% range for the last couple of years, kids think the sky is falling. And so that's just the norm. The norm isn't interest rates, 2 to 4%. A low interest rate, traditionally, if we go back the last, 50 years, is high 5s or low 6s. So, and I think we're seeing an uptick in, home buying, now that we have been in the low 6s and even broke below 6 there for a little bit. And so what do you feel about the housing market and getting into the house for the younger generations out there?
Well, I have very few friends. I do have some, but very few.
You have very few friends?
Okay.
Did you mean?
You have to let me finish the statement first.
Right, go ahead.
A couple number of friends that own homes.
Mm-hmm.
I have more friends that are renters than are not. And in my opinion, the friends of mine that do own their own homes are lucky and have the right extended family situation to help them out and get started.
Yeah.
So I just find it hard to believe that somebody in my generation, and trying to have kids and start that next chapter can afford to own their own home, start a family, the wife or one of the parents being a stay-at-home parent.
That's almost impossible, right?
It's almost impossible.
Takes dual income.
It takes dual income. And one of those incomes, well, this is the flip side of the coin. One of those incomes pretty much goes to childcare.
Yep.
Childcare is ridiculously through the roof.
Yeah.
And so
exactly.
On the other side, on that side, maybe you might as well have one stay-at-home parent, because if one check is going to go entirely to childcare,
it makes no sense. They'd have a better life being, having somebody at home.
Right.
Yep. What's interesting to me is that, again, this idea that, it's a terrible time to have kids. Well, I can tell you, at least from our perspective and the clients that we help, that families find a way. It might take a village now, but families find a way to help out family. In fact, we pride ourselves on that. I think we have, and I don't know the number, we have lots of families where they're helping, their grandkids. We have some families that are helping their great grandkids. And so that's one of the things that we're proud of, is that when we work with you, generally we see that, families of all ages refer their siblings or their friends or their kids or grandkids. And then we pass on the household, the combined investment amount, to discount our fee. So if you're a large client of ours, and so let's say you have 7 figures and you're paying 1% or less annually, we then pass that on to your kids and grandkids. So if your grandkids don't have a 7-figure account, or they're just starting out, then we don't charge them, what that amount qualifies them for, which is typically our full fee. No, we charge them the household fee. So by working with us, your family gets the benefit of, our portfolio management, our financial planning integration, and active management of that plan to accomplishing your goals. And we pass that on. Your family then gets, a plan. We don't charge separately for planning, by the way. It's just one advisory fee, and that covers anything that we do for you. It covers, how often we meet. It covers regularly updating your financial plan. It covers actively managing your portfolio and rebalancing it when necessary. And that's crucial, by the way. I'm just going to get on a little side note here, is that we are active money managers, not passive. We don't hire funds or some third-party manager that charges you either embedded fees or a management fee on top of our financial planning and investment management fee. We build you a custom portfolio designed to meet your goals and objective without passing that responsibility on to somebody else for an additional fee. That always amazes me, that so often when people bring in their accounts for us to give them a second opinion, that's one of the things we do on our no obligation consultation, by the way, that we find that they're outsourcing, their management of your portfolio or account to a third party, but they're still charging you an advisory fee on top of that. It makes no sense to me. Or they charge you an additional fee for doing a financial plan, and then charge another fee when they update that financial plan. We don't do that. Everything is included in whatever our fee is, and then we regularly review your plan, review your portfolio, And there is no transaction charges or commissions that we're charging you or additional fees. And so if you're looking at your statement and you see a bunch of mutual funds on there or the name of some third-party manager that your advisor has hired to put together or manage your investments, that means you're being charged not just that advisory fee, but also fees inside of those funds and potentially another, what's called a separately managed account advisory fee on top of that. That's insane. Often when we do these second opinions, we'll find that the savings that we find by having a custom portfolio that we build and manage for you saves what we're paying, embedded in funds or with separately managed accounts. So give us a call for a no obligation consultation at 916-967-3500. Also, if you want to learn more about why we feel we're better than other advisory firms, come to our seminar on April 29th from 6 to 7:30 p.m. in Walnut Creek at Diablo Hills Golf Club. Again, that's April 29th from 6 to 7:30 p.m. at Diablo Hills Golf Club in Walnut Creek. Call 916-967-3500. You're listening to the Wise Money Guys, Wise Money Guy and Gal, John Schambra and Madison Schambra. Stay tuned. We'll be right back. Hello and welcome back to the Wise Money Guys radio show. I'm your co-host, John Schambra. I'm here with Madison Schambra. And I thought of another question that's, I think, so pertinent to what I was saying earlier about it takes a village and it takes a family, and that we're so proud that, the families that we serve that hire us to manage their money, we help multiple generations. And then it dawned on me that, I think it's going to be harder and harder to be able to do what we've been able to do what my parents have been able to do, which is help your family be successful. Maybe it's gifting them money every year, or maybe it's helping them. As you said, you have some friends that got help from their family to get the down payment to buy a house or whatever the case may be. Or in this case, you're a successor to our business. But how do you feel? Does AI scare you? I mean, how do you see it from how it's affecting, jobs for zillennials or millennials or, whatever you were saying earlier?
I can't stand AI.
Yeah.
From a experience perspective, when I was in HR, I did a lot of recruiting work.
Yeah.
And when you post a job, AI now filters out resumes and you won't even see them if that resume doesn't have a keyword. And so no human eyes are actually looking at your resume.
So how were you finding that you would get past that?
I just did my due diligence and went through every single one.
So you weren't, employing an AI bot, I guess, in this case, to weed through all the resumes you were getting.
Yeah, no, a lot of these job platforms have it built in now. Like LinkedIn, a lot of the job postings will even be scams just to collect your data. And it's all AI generated. And believe it or not, my generation gets a lot of our news and information from social media now. Right. And I don't know how many testimonies I've seen of people who they can't even get an entry-level job. When they lose their job, they're unemployed for 2 to 3 years. And entry level now means you need 2 to 3, sometimes 5 years of experience. And they're not even hiring college graduates anymore. Yeah,
financially, I think the wave of the future, especially from a planning perspective, it used to be that, one of the big modules of a financial plan is college planning. I think college planning, especially if it's going to a private university or a name, you got your master's at USC. And probably at the time, it made sense to spend, that level of money because, having a master's is still meaningful. However, there's a lot of degrees that I don't think are going to be worth the cost of the education. Do you agree with that?
I think in some ways it depends. For me, when I got my master's, I wanted to go into a highly competitive industry,
right?
Professional sports.
Right.
With having no internship experience in sports before, I don't think I would have gotten my foot in the door without a master's degree.
Right. And
that was for an entry-level role. I think that the master's degree is what got me that entry-level role.
Probably so. The reality is, though, as you said earlier, that some of these kids, because let's face it, you're still a kid, even when you come out of college, for the most part, if you spent hundreds of thousands of dollars, and it's for, it was in business or history or something philosophical or theoretical, probably not worth the money in my opinion. Probably better now to do something more vocational oriented. I still think, we got a lot of legs for skilled labor. I think it's going to be, quite some time till we see robots replacing electricians and plumbers or roofers or framers and it's probably in the best interest of companies, especially AI companies, to now turn into, especially the leadership, economists. And this is something that I don't know if I've shared on the show, but I don't think from the AI perspective that the companies creating and the minds behind these companies that are developing artificial intelligence, robotics, automation, they're creating the demise of their own jobs.
Two of the most worthless degrees these days, computer engineering and computer science.
Right, because they teach themselves.
Right.
And what would take a coder,
They're coding themselves out
days, weeks, years, is literally done in a fraction of a second. So small of a time amount that you can't even measure what fraction of a second it is. And so the reality is that the future is going to be very different. Now, I think there's things that the human experience that people will always crave or want in their product or service. I think, in fact, we may go to where things become so sterile, because a computer, cold, machine, mechanical, metal environment, I think people will actually end up paying more to, meet with a doctor, meet with a lawyer, meet with their portfolio manager, have a premium meal prepared by a person, delivered by a person, go to sporting events still that are people playing, not, because now there's robot wars and all these things and virtual sports. And I think it'll be a long time till those things are replaced.
Well, I can't imagine AI ever being able to replicate human emotion and human connection.
It can't. It has no soul.
And think about, even if you're calling the pharmacy, you get a virtual assistant. And how frustrating is it whenever you call a business, you get a virtual assistant? You want to just go straight and talk to a person.
Yeah. The reality is, from an investment perspective, if you're scared about AI, and the reason why you might be scared is because, again, if some of the statistics out there, well, I guess they're not statistics because they haven't been measured yet. Their future potential statistics is that the percentage of certain jobs that will go away is a very large percentage. Now, if that happens, that would mean that, a company's output, although productivity may be increasing, if there's no demand for the supply that goes up with increased productivity, the profitability of that enterprise goes down. And if the profitability of that enterprise goes down, guess what? The stock price goes down, and then wealth goes down, overall. Now, that being said, baby boomers who are in their 60s, 70s, and 80s, youngest being, born in 1964, oldest being born in 1946, control 85 trillion. And that is why our company and our profession is safe for a while, because here and around the world, there is billions of people between the ages of, 55 and 95 that, are traditionally still going to want and do things and demand things the same way they've always done it. So it'll be some time until, this industrial revolution is completely something entire. The world looks entirely different. And until then, please give the Wise Money Guys a call at 916-967-3500 for your no obligation consultation, or to register for our seminar on Wednesday, the 29th at Diablo Hills Golf Club from 6 to 7:30 p.m. Call 916-967-3500. I hope you enjoyed listening to the Wise Money Guy and the Wise Money Gal. Have a wonderful Saturday. Come back and listen to us next weekend. Bye, all.
Bye.